Hi there, and welcome to the bottom line. In this video, I'm going to cover how I assess the stage of any stock. When I say stage, I'm simply comparing the price with where the earnings are right now. Now, in this, we're going to broadly cover these pointers. First, what drives the price? What is the basic principle that is going to be understood so that we can understand where the price is as in comparison to the earnings is the second important point. Then introduction to the three stages, namely dissonance, resonance, and resolution, and then some conclusions on how I use this to basically filter out a few stocks or decide on my investment decisions. So let's get on with it. If we look at what drives price in all stocks and assets, it is the earnings that drive the prices of any asset. If a particular company or the underlying asset of any instrument is doing well, the price eventually does well, right? And this is, I'm talking about this in a slightly long term perspective. In short term, you may find intraday movements, you may find smaller time frame movements that are always persistent. But broadly in the long term, we will always see that the price is being driven by earnings at the end of the day, right? If you look at the basic principle is very simple. Price and earnings will eventually converge, right? Now, it can happen positively as well as negatively. So, if there are earnings that have been going strongly up and the price has been lagging behind, eventually you will see that the price is converging with the earnings. Vice versa, if the price has gone up too much, but the earnings have dropped recently in the company and the company has not been doing well, you will see the prices to come lower and converge with the earning figures. Now, the three stages, which are very important, and I've given a charting example for all three of these, is dissonance, resonance, and resolution. If we try and understand dissonance, what it means is that the earnings of a particular company have strongly risen in the recent times, but the stock price has remained muted at a certain level. Now, this chart, I've purposely not named any company here because it is important that we understand this objectively without trying to understand what the company is or what company this chart belongs to. But if you see, this is one of the recent IPOs of 2022. But if you see, it was the earnings line is well above the current stock price. What it means is that there is a dissonance between the two fundamentals of the company, right? The earnings have been increasing significantly, but the stock price has remained muted or below the earnings line for an extended period of time. If we understand the second stage is resonance, which means that with the earnings growing, the stock price has already moved as much as the earnings have grown, and it is now very, very close to the broader price and the earnings of the company, so that they are able to see that there is not much there is not much difference between the earnings and the price line. Now, that is called as resonance, which you have also heard in physics in terms of frequency, right? Both two things or two frequencies going in line with each other. Here, the frequencies are earnings and the price. The third stage is resonance, where the earnings have significantly reduced as compared to the price of the stock, right? So the earnings are in a particular line or they have reduced, but the stock price has already gone way beyond the earnings line, right? And that is where I call the stock stage as resolution. So these are broadly the three stages: the dissonance, where price lags the earnings; resonance, where price and earnings are going well in structure with each other; and resolution is where the price has surpassed the earnings line. Now, what do I do with this information for any stock, right? You pick up any stock, if you have the chart of it, if you have the earnings plotted for that particular stock, you are going to be able to apply this concept very easily. So, what do? I never invest in a stock that is either in resonance or in resolution. That means the stock does not have any room for growth because it has already been priced to where the earnings are as of now. Now, these kinds of stocks are generally bound to either go flat for a really extended period of time, could go 1 to 2 years, or could just fall in value, right, to become attractive to buy again. Now, I always look for stocks that are in dissonance. That means there is a strong difference between the earnings and the price of the stock that is currently is priced at. Before that, if for us to apply this particular concept, it is very important that we only pick stocks that are fundamentally strong. That does not mean I'm trying to pick only the large cap stocks. There are also small cap stocks which are fundamentally extremely good. Those stocks are the ones where this concept will apply. If you take a fundamentally weak stock and try to apply this, you will see the stock price falling well below and the dissonance being created further to where one has bought. And they will see that the stock price keeps on falling because the fundamentals are just not supportive of the price, right? No earnings, no EPS, no value to the shareholders, and no rise in the stock price. As simple as that, right? In stocks that I have fundamentally strong positions in, and there is a strong dissonance, I invest on every single red candle that I see. Every time there is a red candle in the stock, I am interested to buy it up and hold on to the position. One of the most important things that I follow in this is I do not expect a immediate rise in stock, immediate rise in value, immediate rise in PNL. I do not wish to see, I do not expect to see my portfolio growing suddenly green and showing me good amount of returns. It takes time, it takes quarters of results to come up, and then eventually you will see, here is the earning line and the stock price just comes and converges with it. Again, there is no guarantee that this will always happen positively. If a company does not do well in the coming year, you will see the other way around, that the earnings come back and converge with the price. Either ways, we all take and bear that risk whenever we are making the first bet on any stock. That's the nature of equity markets. And even if you get, even if I get close to 5 decisions correct long term out of 10, it will still make significant amount of money, significant amount of value can be created, right? So I hope this adds value to your stock selection. Again, please do it with your own analysis. This is what I do. It can change, vary what comforts you as a person, but this is what I follow as a process and try to get the best value stocks that are available in the market with strong fundamentals and good amount of dissonance. I hope this has added good value to your understanding, and I'll see you in the next one. Bye bye.